Every generation builds its dream on borrowed time. For our grandparents, it was the 30-year mortgage, a promise that after 3 decades of steady work, they could finally call something their own. But now, a new idea is echoing across the nation: a 50-year mortgage. It started with a headline, a proposal, a single post that shook the internet. Thanks to President Trump, we are working on the 50-year mortgage, a complete game changer. Some called it innovation, others called it desperation. But behind all the noise, one truth stood out. The American dream is changing. Picture this. You're standing on the front porch of a home that costs $410,000, the median price of a house in America today. You've saved, you've planned, you've worked hard, and now you're staring at numbers that don't seem to make sense anymore. Interest rates are hovering near 6%. The 30-year mortgage, once the golden standard, feels out of reach for millions, and now a new offer appears. Cut your monthly payments. Stretch your loan to 50 years. It sounds almost magical, right? More affordable payments. More breathing room. But what does it really mean when a nation starts signing contracts that last half a century? The question isn't just financial, it's philosophical. When we take on a 50-year loan, we're not just borrowing money, we're borrowing the future. Because if a 30-year mortgage already locks us into decades of payments, what happens when that timeline stretches to half a lifetime? Will we still own our homes? Or will our homes own us? This is the question that millions of Americans and economists are asking right now. And today, we're diving deep, not to judge the idea, not to praise or attack, but to understand it through the lens of numbers, history, and the human spirit. Let's strip away the headlines and look at the math. Imagine a $400,000 loan at 6% interest. That's your baseline. On a traditional 30-year fixed mortgage, your monthly payment would be around $2,390. Stretch that same loan to 50 years, and your payment drops to about $2,100 a month. A difference of roughly $293 a month, almost the cost of a car payment, or a week's worth of groceries for a family of 4. At first glance, that seems like a relief. Lower payments mean more flexibility. But here's where the story turns. Over time, that small relief carries a massive cost. Because while the 30-year loan costs you about $863,000 in total payments, the 50-year version stretches past $1.26 million. That's nearly $400,000 more in lifetime payments just to own the same house. And that's not some distant number on a spreadsheet. That's your children's tuition, your retirement fund, your chance to start a business. Gone because of interest. Time. It's the most valuable thing we have, yet it's the first thing we trade away. Mortgages aren't just about money. They're about commitment. A 30-year loan already asks you to stay faithful for 3 decades. Through career changes, recessions, even pandemics. But a 50-year mortgage? That's an entire economic lifetime. Most people who sign that contract will never make the final payment themselves. Their children, or their estate, might. And here's the twist. For the first 10 to 15 years of that 50-year mortgage, almost every payment you make goes straight to interest, not to your principal. In year 1 alone, out of roughly $25,000 in payments, less than $1,400 goes toward the actual loan balance. That means after a full year of paying your mortgage, you still owe about $398,000 of your $400,000 loan. You've worked all year, and the mountain hasn't moved. Why would anyone agree to this? Because debt has become normalized. We've been trained to think in monthly payments, not in total cost. We ask, can I afford $2,000 a month? Instead of, can I afford $1.2 million over 50 years? It's not greed, it's survival. Wages have stagnated. Housing prices have skyrocketed. And so the system adapts, not by lowering prices, but by stretching the timeline. That's the real story behind the 50-year mortgage. It's not just a financial innovation. It's a symptom of an economy that's running out of breathing room. Let's rewind the clock. In 1934, President Franklin D. Roosevelt helped introduce the 30-year mortgage through the Federal Housing Administration. At the time, it was revolutionary. Before that, most home loans were short-term, 5 years, 10 years max, with large balloon payments at the end. The 30-year mortgage changed that. It gave the working class a chance to buy homes, to build equity, to dream long-term. It became a cornerstone of the modern middle class. Imagine this: a society where time itself becomes the new currency. We used to measure wealth in dollars, then in assets, and now we measure it in years of our lives. A 50-year mortgage is more than a financial product. It's a symbol of that shift. We are literally buying comfort now, with decades of our future labor. When a generation agrees to take on half a century of debt, it sends a message. We've accepted that owning something today means sacrificing tomorrow. And that's not always a bad thing, if it's done with awareness. Because every deal we make with time carries both risk and reward. For some, the idea of a 50-year loan sounds impossible. Who wants to be paying a mortgage at 80 years old? But for others, it's hope. It's a chance to finally step through a front door that once felt locked forever. That's the paradox of progress. The same system that traps one person in debt can open a door for another. The difference lies in how you use it. If you use that longer timeline to build, invest, and grow, it's a ladder. But if you use it to stretch beyond your means, it's a leash. The emotional side of money is powerful. It's not about spreadsheets. It's about self-worth, safety, and identity. And that's why conversations about mortgages hit so deep. Because at their core, they're about home. Home isn't just walls and a roof. It's belonging. It's legacy. It's the place you build your story. That's why people will sign 50-year contracts, not because they love debt, but because they love the idea of permanence in an uncertain world. This isn't the first time a financial innovation has divided public opinion. When the 30-year mortgage first appeared in the 1930s, many critics called it reckless. They said it would destroy banks, weaken families, and create bubbles. And yet, it became one of the cornerstones of the modern middle class. So maybe, just maybe, the 50-year mortgage is history repeating itself. Maybe it's the next evolution of a society that refuses to give up on the dream of ownership. But here's the difference. In Roosevelt's time, wages and housing prices grew together. Today, they're on opposite ends of the spectrum. Housing has outpaced income for decades. And every time the market adjusts, the dream stretches further away until only debt can bridge the gap. That's why this new idea feels both visionary and dangerous. Because if we stretch the system too far, it might not bend. It might break. Let's talk about what happens when a loan outlives the borrower. In a 50-year mortgage, most homeowners will spend the first 20 years paying mostly interest. That means if they decide to sell or refinance, they'll have barely chipped away at the principal. In other words, 2 decades of payments, and you still owe nearly what you borrowed. Now imagine passing that loan to your children. They inherit not just the home, but the obligation tied to it. In financial terms, that's called intergenerational debt. And it's not just a number on a contract. It's a new kind of inheritance, one that trades land for liability. But here's the other side. If that same family builds generational wealth alongside the debt, investing, saving, learning, that house could become a long-term asset. The debt becomes a bridge, not a burden. So the lesson isn't avoid debt at all costs. It's understand what kind of debt you're carrying and why. Let's look at this through another lens. What if the 50-year mortgage isn't a trap, but a tool? What if it's not about what the loan takes, but what it gives you the chance to build? If you can lower your payments and use that difference wisely, investing $292 a month for 50 years at 8%, you could build wealth worth over $2 million nominally, or roughly $500,000 in today's money. That's not a fantasy. That's the math of compounding. The problem isn't that opportunities don't exist, it's that we rarely act on them consistently. Because discipline is harder to sell than convenience. The system offers the 50-year mortgage as a way to afford more today. But the smart ones will use it to buy freedom tomorrow. Economists warn that extending debt timelines doesn't fix affordability, it hides it. It's like stretching a rubber band. The tension doesn't disappear, it just spreads out. When people can borrow more, prices rise to match. It happened with student loans. It happened with car financing. And it's happening now with homes. A 50-year mortgage may make the monthly payment easier, but it can push housing prices even higher, pulling the latter further out of reach for the next wave of buyers.